Hi everyone. Today we're going to talk about Qualcomm's second quarter fiscal 2026 results. The quarter ended March 29th, and on the surface this looks like a soft print. Revenue down 2%, earnings per share down 7%. But underneath, this is one of the most interesting transitional quarters Qualcomm has had in a decade. Let's dig in. So here's the surprise of the quarter. While Wall Street obsessed over Qualcomm's smartphone exposure, automotive revenues hit a record $1.3 billion, up 38% year over year. This is a chip company quietly turning into something other than a phone chip company, and the market hasn't fully caught on yet. And here's the second surprise. Right alongside the results, Qualcomm announced a brand new $20 billion buyback authorization, on top of $2.1 billion still remaining from the prior program. They also raised the dividend for the 23rd consecutive year. That's a strong message. Management thinks the stock is cheap, and they're not waiting for a recovery to act. Hi everyone. Today we are going to take a look at Qualcomm's second quarter fiscal 2026 results. We'll start by covering who Qualcomm is and the two engines that drive the company, then walk through the scorecard for the quarter, where the revenue came from, where the money went, the outlook for the rest of the year, and we'll finish with the bull versus bear case. Let's begin with the basics. Who exactly is Qualcomm today? Qualcomm runs two engines. The first is QCT, the chip business that is Snapdragon in your phone, increasingly your car and even your PC. The second is QTL, the licensing business that monetizes the foundational cellular patent portfolio. QCT is roughly 86% of the top line, but QTL is the high-margin annuity. They get to monetize the same R&D twice. First is silicon, then is royalty. Here's the picture in one diagram. Handsets at $6 billion are still by far the biggest stream, bigger than Auto, IoT, and licensing combined. But it's the only stream that's shrinking. Everything else is growing. So when you hear the headline that revenue was down 2%, it's really one big stream pulling four others backwards. Qualcomm doesn't have one competitor. It has different competitors in every business. Apple in vertical integration, MediaTek in mid-tier Android, NVIDIA in automotive and data center, ARM, surprisingly, in licensing versus silicon, and Intel in PCs. The pitch from management is that no other semiconductor company spans milliwatts to kilowatts from a wearable to a server rack on the same core IP. That's the moat they're trying to widen. 40 years of cellular IP. That's the foundation. The reason Qualcomm can spend $2.5 billion on R&D every single quarter and still hand back $3.7 billion to shareholders is that QTL, the licensing business, runs at a 72% operating margin. It's the engine that funds every new bet, from automotive to PCs to data center. Now let's look at Q2 by the numbers. The headline print was soft, but underneath there's a hard pivot happening. And the scorecard you're about to see tells both stories at once. Here's the full scorecard. Top row, revenue $10.6 billion, down 2%. Earnings per share $2.65, down 7%. Hits the high end of guidance, but down year over year. Middle row, auto hit a record $1.3 billion, up 38%, and combined with IoT, the diversification basket is up 20%. Bottom row, $3.7 billion returned this quarter, plus a brand new $20 billion repurchase authorization. Soft top line, very strong capital return. $10.6 billion in revenue. That's at the high end of the guidance Qualcomm gave back in February. It's down 2% year over year, but the company hit the top of the tone range despite a genuinely brutal memory pricing environment hitting handset OEM build plants. Credit the licensing business and auto for the catch. Here's the thing that jumps out when you read down the income statement. Every line tied to the chip business, revenue, EPS, EBT, and margin is down. Every line tied to the licensing business is up. Same quarter, same company, two completely different stories. QCT margin compressed 3 points to 27. QTL margin actually expanded 2 points to 72. Diversification helps, but you can't see it in the headline yet. So where did the money actually come from this quarter? Qualcomm has 4 revenue streams, and each one has its own story. 1 is shrinking hard, 3 are growing, and 1 of them is genuinely breaking out. Inside the chip business, handsets are still about 2/3 of QCT, $6 billion.
IoT is 1.7, Auto is 1.3. The mix today still looks like a phone company, but the slope of the other two slices over the next 4 quarters is what's going to re-rate this stock, not the absolute size of handsets.
Look at this picture. 3 lines going up, 1 going down. Auto plus 38, IoT plus 9, licensing plus 5, and handsets minus 13. The bear case for Qualcomm has always been, it's just a phone chip company. The slope of these 4 lines is the bull case that says, not for much longer.
Here's a counter-narrative point. The reason handsets are weak isn't that demand collapsed, sell-through actually held up. It's that AI data center memory demand spiked, memory prices ripped, and Chinese OEMs responded by cutting build plans and drawing down inventory. So ironically, the AI boom that's juicing NVIDIA's numbers is squeezing Qualcomm's handset OEMs. Management says China bottoms in the 3rd quarter, with sequential growth returning in the 4th. So this is hopefully a 1 or 2 quarter air pocket, not a structural break.
Automotive crossed $5 billion in annualized revenue for the first time this quarter. There are now over 1 million cars running automated driving on Snapdragon Ride. Bosch alone has shipped more than 10 million Qualcomm-powered cockpit computers. And the new 4th-gen digital chassis brings 3 times the CPU, 3 times the GPU, and 12 times the NPU performance of the prior gen. Management is guiding to a $6 billion-plus run rate by the end of fiscal 26. A record quarter, $1.3 billion in automotive revenue, up 38%, and management said on the call that year-over-year growth accelerates to roughly 50% next quarter. This is no longer optionality on a future business, this is real revenue scaling now.
IoT was up 9% at $1.7 billion. The interesting thing here isn't the growth rate, it's the design pipeline. Agentic AI workloads on edge devices are forcing a hardware refresh across industrial, robotics, and wearables. Dragonwing IQ10 brings 700 TOPS of on-device AI. Wear Elite is the first NPU-powered wearable platform, and design wins with Neura, Figure, and Siemens suggest the IoT pipeline is the most diverse it's ever been. The licensing business, QTL, is the quiet hero of this quarter. $1.4 billion in revenue, up 5%, but the margin expanded 2 points to 72% with operating profit of nearly $1 billion on this one segment alone. Every Snapdragon competitor, MediaTek, Apple, even Samsung's in-house chips pays into this stream, and it's what funds the diversification bet without touching the balance sheet. Here's the diversification story in one number. Auto plus IoT combined grew 20% year over year. That basket is now nearly 30% of the company, and the slope is accelerating. The bull case for Qualcomm in 5 years is that this basket is the majority of QCT, and handsets are the cyclical sidecar, not the other way around. Now to where the money went. The interesting thing this quarter is that spending is up and capital returns are up at the same time. Let's see how that math works. Here's the income statement, non-GAAP, $10.6 billion in revenue, $4.8 billion in cost of revenue, $1.9 billion in R&D, that's notable, we'll come back to it, $647 million in selling and admin, that gets you to $3.28 billion of operating income. Strip a little net interest and a tax rate of 12.5%, and you land on $2.84 billion of net income. Note that the GAAP number was much higher because of a one-time $5.7 billion tax valuation allowance release. That's not earning power. R&D is the line that's running. $2.46 billion this quarter alone, up 11% year over year. For the first half, R&D is up nearly $500 million versus last year. This is what the diversification bet costs. Data center silicon, 6G, agentic AI, new automotive platforms, robotics. Investors who want auto, IoT, and data center growth need to be willing to pay for this line. It is not shrinking anytime soon. In just the first 6 months of fiscal 26, Qualcomm has returned $7.3 billion to shareholders. $5.4 billion in buybacks, 30% above last year, and $1.9 billion in dividends, funded entirely from operating cash flow. Diluted share count is already down from 1.12 billion to 1.07, and on top of that, a fresh $20 billion authorization.
The pace is accelerating, which is the cleanest signal management can send. $5.4 billion of stock bought back in just 6 months. And on top of that, the dividend was raised for the 23rd consecutive year. If you're a long-term holder, this is the line that says, hold the dip, get paid to wait, watch the diversification compound. So, what comes next? Q3 is the pivot quarter. China handsets bottom out, Automotive accelerates, and a brand new business starts to ship. Here's what management is signaling for the rest of the year. Here's the Q3 guide. Revenue $9.2 to $10 billion. That's a sequential step down. EPS $2.10 to $2.30. The yellow lines are handset and headline. The green lines are Auto and IoT. And the new blue line is the most important one. Initial shipments of custom silicon for a leading hyperscaler later this calendar year. That last line is the new business Qualcomm is opening up. Auto is the easiest line of sight in the deck. Today's run rate is already over $5 billion annualized. Management's exit target for fiscal 26 is $6 billion plus. That's mostly already in backlog. The fourth-generation digital chassis ramps into shipments later this fiscal year, and Bosch and Wave partnerships expand the ADAS pipeline. Auto is no longer a hope, it's a calendar. Management has a clear thesis on China handsets. Q2 was the under-shipping quarter. Q3 is the bottom. Q4 returns to sequential growth, and by fiscal 27, agentic smartphones, devices like ZTE Nubia and Xiaomi Mi Claw that integrate Qualcomm's AI agent framework, start an upgrade cycle in the premium tier. The reason management can call the bottom this confidently is the licensing business gives them a direct read on sell-through, separate from what their own chip orders are saying. This is the slide that could change the multiple on the stock. For the first time, Qualcomm has a confirmed custom silicon engagement with a leading hyperscaler. Cristiano Amon described it as a multi-generation engagement, with initial shipments later this calendar year. The Alphawave acquisition gave them the high-speed connectivity. They've been building the CPU, and the full reveal, including the data center roadmap, is at the Investor Day on June 24th. This is the diversification in deal form. 6 partnerships announced this quarter alone, each opening a different door. Wave and Bosch in auto, Neuro Robotics in humanoids, Siemens on the factory floor, Arduino with developers, Snap on smart glasses. None of these depend on phone volumes. This is what a deliberate pivot looks like, executed quarter after quarter. 4 leadership claims worth knowing. Snapdragon X Elite in PCs runs agentic workloads roughly 30% faster than Intel's Panther Lake. Dragonwing IQ 100 brings 700 TOPS of on-device AI for industrial and robotics. Snapdragon Wear Elite is 5 times the CPU performance of the previous generation, and the 6G coalition Qualcomm launched at MWC has over 60 industry partners targeting commercial systems from 2029. None of these are handsets. Mark your calendar. June 24th, New York City, Qualcomm's Investor Day. Full update on the data center plan, physical AI strategy, long-term revenue and margin targets. Honestly, this matters more than the next earnings print. The Q3 number is going to look soft because of the China handset trough, but the Investor Day is where the company makes its case for the next 5 years. Honestly, this is a balanced deck right now. 6 bull arguments, 6 bear arguments. The bear case writes itself. Handsets are down 13, the chip business margin compressed, EPS fell faster than revenue, inventory built up. The bull case rests on slope. Auto plus 38, the diversification basket plus 20, a hyperscaler data center engagement, $20 billion of fresh buyback. The right question isn't, is this quarter good? It's which side of this balance compounds for the next 8 quarters. Here's what to watch from here in priority order. Greens are proven and accelerating. Auto run rate, QTL margin durability. Yellows are near-term execution risks, China bottoming, memory normalizing. Blues are future catalysts, hyperscaler shipments late this year, and Investor Day in June. If the greens hold, the yellows resolve, and the blues land, this is a different Qualcomm in 2027 than it is today. Auto is rising, data center is just starting, phones are bottoming. That's the whole quarter in one line.
The headline numbers won't tell you whether the bet pays off. What will tell you is the next 4 quarters of execution against the diversification roadmap and the Investor Day reveal in June. That's it for today. Don't forget to subscribe.